J.P. Morgan, the man who held Wall Street in his pocket. New York City, early 1900s. Most people know Wall Street from the outside. Shouting traders, flashing numbers, newspaper headlines. But our story today begins behind a thick wooden door in a quiet library on Madison Avenue. The room smells of leather and tobacco. The walls are covered in paintings and books. On a table, there are thick ledgers bound in dark covers, a few telegrams, a silver ashtray. Sitting in a chair that looks almost too small for him is a massive man with a purple nose, deep-set eyes, and a look that can make industrialists, railroad tycoons, and politicians all feel like nervous schoolchildren. His name is John Pierpont Morgan. J.P. Morgan. Morgan is not a self-made street kid. He's born in 1837 into a banking family. His father, Junius Morgan, is already a partner in a London merchant bank. Young John is educated in Boston, Switzerland, and Germany. He grows up bilingual in money and manners. But being born near power and knowing how to use it are not the same thing. Morgan learns to read balance sheets like other people read novels. He studies railroads, steel, telegraphs. He has a particular talent for spotting when something is underpriced, mismanaged, or so chaotic that a strong hand could turn it into a gold mine. And he has something else, an almost unshakable belief that if things are left to disorder, someone, preferably him, should step in. In the late 1800s, the United States is exploding with growth. Railroads crisscross the country. Steel mills roar, oil gushes. It is all messy. Competing lines, duplicate tracks, bankruptcies, price wars. Morgan steps into this chaos with a simple idea: consolidate. He arranges mergers of competing railroads, taking several shaky companies and fusing them into a single, more stable system. In the process, he gains enormous influence. If you control the financing of a railroad network, you have a say in how and where the country grows. Then he does something even bigger. He takes Andrew Carnegie's steel empire, already massive, and orchestrates a deal to buy it and roll it up with other holdings. The result is U.S. Steel, the first billion-dollar corporation in American history. For Morgan, this is not just about size. It is about order. He believes that ruinous competition hurts everyone: owners, workers, and the nation. Better, in his view, to have one large, well-financed company than a dozen desperate ones. Of course, it helps that he and his partners take fat fees along the way. To understand Morgan, you have to picture the way people walked into his office. Industrialists came to him not like peers, but like petitioners. Railway presidents, steel barons, even the US government would sit across from him and explain their problems. He listened, chewed on a cigar, sometimes closed his eyes. And then he would decide. He might underwrite a bond issue, arrange a rescue, demand a restructuring, replace management. He's not just providing capital. He is imposing discipline. In an era before modern securities regulation, before central banks had real teeth in the US, Morgan's personal credibility, the resource of his firm, J.P. Morgan & Co., act as a kind of unofficial regulator. His word can calm markets, or terrify them. One of the clearest examples of his power comes in the 1890s. The US Treasury is running low on gold reserves, thanks to a financial panic and a shaky monetary system. confidence in the dollar falters. This is not just a bookkeeping problem. In the gold standard era, low gold reserves mean the government's promises start to look suspect. So who does the US government call? Not the central bank. The Federal Reserve does not yet exist. They call JP Morgan. Morgan, working with a syndicate of bankers, including the Rothschilds we met last episode, arranges a private sale of US bonds in exchange for gold, stabilizing the Treasury's reserves. Think about that for a second. The government of the United States is rescued by a deal organized in a banker's office. It tells you all you need to know about who holds the financial steering wheel in that moment. But Morgan's most famous performance happens in 1907. The stock market crashes. A major trust company wobbles, then falls. Panic spreads. Depositors line up outside banks. Stock prices swing wildly. The entire financial system teeters on the edge of collapse. Again, no Federal Reserve, no clear lender of last resort. So where do the city's bankers go? They go to Morgan's library. He gathers the leaders of New York's biggest banks and trust companies, locks them in, and effectively says, "We are not leaving until we sort this out." He and a small circle pore over balance sheets, decide which institutions can be saved, which must be allowed to fail, and who needs to chip in how much to stabilize the whole structure. At one point, he reputedly shoves a document across the table and insists that certain bankers sign a rescue agreement, refusing to open the doors until they do. By the end of the crisis, enough emergency capital has been raised, enough deals struck that the panic subsides. The system holds. The newspapers hail Morgan as the man who saved Wall Street. Others, notably in Washington, look at this and think, wait a second. If one private banker can hold the system together, what happens when he cannot? This fear is one of the forces that will push the US to finally create the Federal Reserve in 1913, a year after Morgan's death. Morgan is not loved by everyone. To reformers and trustbusters, he represents everything dangerous about concentrated capital. He sits at the center of interlocking directorates, boards where the same handful of bankers sit on multiple big corporate boards, linking railroads, insurance, and finance. Critics argue that this money trust can fix prices, crush competitors, and wield too much quiet influence over the economy. In 1912, Morgan is called before a congressional committee to be questioned about his power. He appears, massive and formal, and delivers a line that becomes famous. "A man I do not trust could not get money from me on all the bonds in Christendom." It is part defense, part warning. In a world where he decides which deals get funded, his personal judgment becomes a public issue. Outside the office, Morgan is a complex figure. He is a voracious collector of art, manuscripts, and rare books. His library in New York, later opened to the public as the Morgan Library and Museum, is a physical symbol of financial capital turning into cultural capital. He can be gruff, impatient, blunt to the point of rudeness. But those who knew him well speak of loyalty to friends and an almost old-fashioned sense of honor in agreements. He dies in 1913 in Italy. When the news reaches New York, the stock exchange puts its flags at half-mast. one newspaper writes that JP Morgan, the financial world's greatest power, died today. Yet even as they mourn him, the system is already changing. Regulators are tightening rules. Public suspicion of money kings is growing. The age when one banker can single-handedly corral Wall Street in his library is fading. But Morgan's legacy lives on in the structures he helped build. The modern investment bank, the large-scale corporate merger, the idea that finance can act as a shock absorber in crisis, though now that role is more formally assigned to central banks and governments. Where the Rothschilds showed how a family firm could knit together cross-border finance for states, Morgan shows how an American house can knit together corporations into industrial giants and step in when markets freeze. His firm, through splits and mergers, will eventually turn into pieces you recognize today: JP Morgan, Morgan Stanley, and others. But as Morgan's era closes, something else is brewing a few blocks away. A new kind of firm is rising, not one built on one man's intimidating presence and private library, but on a more systematic approach to underwriting, partnerships, and, eventually, trading. If Morgan is old world, mahogany, cigars, whispered deals in back rooms, the next house in our story will grow up with IPOs, stock offerings, and the more anonymous churn of modern markets. In 1869, while Morgan is still a young man learning the family trade, a German immigrant named Markus Goldmann opens a small firm in New York, dealing in commercial paper, short-term IOUs that help businesses smooth their cash flow. It is a modest operation, handwritten notes, a few clients. Over time, his son-in-law, Samuel Sachs, joins the business. The firm takes on a new name: Goldman, Sachs & Co. Their niche is different from Morgan's government loans and giant industrial consolidations. Goldman Sachs will specialize in helping companies raise money from the public, packaging trust and risk into securities and selling them to investors. It will ride the waves of booms and crashes, grow from a family partnership into a global symbol. Sometimes of brilliance, sometimes of hubris, sometimes both at once. If JP Morgan is the archetype of the old-school banker-statesman, Goldman Sachs will become the archetype of the modern Wall Street deal machine. Next time, we will step into Goldman's world, from commercial paper to big IPOs, from the 1929 crash to the 2008 crisis, from quiet partnerships to a bank so influential, some call it the firm, or even government Sachs. We will ask, how do you turn relationships into underwriting mandates? How do you survive repeated crises and come out stronger? And what happens when a company's name becomes shorthand for both financial genius and everything people hate about finance? If Morgan showed how one man could stabilize a system, Goldman Sachs will show how a whole institution can learn to dance with its volatility.